Welcome to our podcast, where we share our professional knowledge and experience for those considering commercial mortgages or loans. If you are in need of commercial mortgages or loans, contact us for a no-obligation free consultation. Let's start today's episode. Management Buyout Loans Guide. A management buyout, MBO, can be a game changer for businesses, opening up new opportunities for growth and enabling the existing management team to take control of the company. An MBO is a financial transaction in which the management team of a company acquires their business from the existing owner with the aid of external financing. This type of transaction can offer numerous benefits to both the management team and the company, but securing the necessary funding can be a challenge. Furthermore, understanding the intricacies involved in the MBO process is crucial to ensure a smooth and successful transition. What is a management buyout? A management buyout, MBO, refers to a process where the management team of a company takes control and ownership of the business by purchasing all, or a part of it from the current owners. Typically, this is done with the help of external financing, including banks and equity groups. In an MBO, you would ideally assemble a strong and balanced management team that can drive the business forward, ensuring increased profitability over time. This team plays a crucial role in the success of the buyout and contributes to the growth of the company after the transaction. MBOs often occur when the current owners wish to retire or move on to other ventures. Thus, the management team steps in to ensure the business's continuity and success. It is essential, however, to consider the myriad of potential risks and pressures involved in executing an MBO, as these transactions can be quite challenging. Equity finance, particularly from private equity firms, can help support an MBO by providing the necessary capital for the acquisition. Private equity firms often partner with management buyouts and offer expertise, resources, and connections that can uplift the business. In summary, a management buyout empowers your team to take control of the company's future by acquiring ownership. It is crucial to assemble a capable management team and consider using equity financing options to execute a successful MBO. The role of management in buyout. During a management buyout, MBO, it is crucial for the management team to step up and take on additional responsibilities. As a key player in the process, your management skills and leadership will be put to the test while you guide your business through this major transition. Here are some ways you can ensure a successful buyout and a brighter future for your company. Firstly, assemble a balanced and competent management team. As the beating heart of your new business acquisition, it is essential that you have a dynamic group of individuals who can drive business growth and increase profitability in the long run. This team should ideally include representatives from various departments with a mix of skills, expertise, and experience. As a CEO, your role in selecting and leading this team cannot be overstated. Effective communication is particularly important during an MBO. Keep your team informed about the buyout process and motivate them to work towards common goals by providing clear objectives and expectations. Be prepared to address any concerns or issues raised by your management team during the buyout process, as these can impact the overall success of the deal. Take charge of the due diligence process by kicking the tires and learning everything you can about the business. Use a planning stage guided by key questions and risks identified by your management team. Aim to answer and mitigate any concerns that may arise. This not only demonstrates your commitment to the buyout but also ensures a smoother transition once the deal is completed. As the acting management, you should also proactively seek external financing options for the MBO. Explore various financing strategies and connect with banks, equity groups, or alternative lenders to secure the funds needed for the buyout. Be prepared to present a strong business case to these financiers, showcasing your management team's capabilities and the potential for growth under your control. In conclusion, demonstrating strong leadership and steering clear of exaggerated claims is key to a successful management buyout. By adequately preparing your management team, communicating effectively, conducting thorough due diligence, and securing appropriate financing, you will have a solid foundation to take control of your business and drive it towards a prosperous future. Financing options. When considering a management buyout, MBO, it's essential to explore various financing options to support the transaction. This will enable you and your management team to take control of the business without being dependent on the old owners. In this guide, we discuss some of the key financing options to consider during the MBO process. Debt financing is a common method used to fund management buyouts. In this option, your management team can borrow from a bank or financial institution to buy the business assets. Debt financing can provide you with a significant amount of capital required for the MBO, but it's crucial to have a solid plan to repay the loan as per the agreed terms. Equity finance is another way to raise funds for an MBO. This involves selling shares or ownership stakes to investors, typically private equity firms or venture capital firms, to generate the funds required for the buyout. Through this financing option, you provide the investors with partial ownership in exchange for their capital. However, this may result in reduced control for the management team. For additional information about equity finance, visit our business loans site. Your management team may also consider mezzanine financing, a hybrid form of financing that combines elements of debt and equity financing. In this case, lenders provide you with a loan that can be converted into equity if it isn't repaid as agreed. This financing option is typically more expensive than debt financing, but it offers more flexibility and fewer restrictions on your business operations. You can find more information about mezzanine financing by visiting Mezzanine Lending Expert Guide. There are other alternative financing options to evaluate, such as asset-based loans and invoice finance, which can also support your MBO. For instance, asset-based loans involve using the company's assets as collateral, while invoice finance leverages unpaid invoices to provide cash flow during the buyout process. To explore these options, please contact us. In summary, to successfully complete a management buyout, it's imperative that you and your management team carefully assess various financing options and select the one that best suits your needs and the long-term objectives of your business. Investors and stakeholders. When considering a management buyout, MBO, it's essential to understand the roles and interests of various investors and stakeholders involved in the process. Engaging with the right entities will crucially impact the success of your MBO. Private equity firms often play a significant role in funding management buyouts. They provide the necessary capital for your management team to acquire the business and share the risks and rewards of the investment. It is important for you to identify private equity firms that align with your business objectives and have a track record of supporting successful MBOs. Establishing a strong relationship with such firms can increase the likelihood of securing their financial backing. Investors also have a major influence in an MBO. These may include angel investors, venture capitalists, or institutional investors, who can bring both financial resources and valuable industry expertise to the table. It's crucial to present a well-prepared and compelling business plan to these potential investors, showcasing the growth potential of your company under the new management. It's worth noting that investors typically focus on various aspects when assessing an MBO opportunity. For example, they will look at the management team's experience and credibility, the company's market position, and the deal structure. Ensuring that your proposal ticks all these boxes will increase your chances of securing the investment needed for a successful MBO. In the context of an MBO, shareholders are also vital stakeholders to consider. Current shareholders may include the existing owners or founders of the business who are interested in selling their stake. Ensuring that these shareholders are engaged in the process and are supportive of the MBO is critical, as they ultimately need to approve the transaction. In some cases, they may even opt to stay involved with the company in some capacity post-MBO, contributing expertise and industry contacts. In conclusion, carefully considering the needs and preferences of all relevant investors and stakeholders is crucial for a successful management buyout. By understanding their expectations and actively engaging with them, you can increase the likelihood of securing the financial backing and support needed for a smooth MBO process and transition to new ownership. Structure of a management buyout deal. When structuring a management buyout (MBO) deal, it is crucial to consider a few essential components. In this section, we will discuss the vital aspects of an MBO transaction, ensuring you have a comprehensive understanding of how this process unfolds. Firstly, assembling your management team is critical to the success of an MBO deal. This team should be well-balanced, able to drive the business forward and increase profitability over time. Your management team will act as the foundation of your new business acquisition, so it is vital to choose individuals wisely. After forming a strong management team, it is essential to examine the shares and stock involved in the MBO. Typically, the management team will purchase the issued share capital or assets of the target company through a holding company. Understanding the worth of these shares and anticipating any potential issues is crucial to the deal's success. Next, assess the capital required to finance the MBO. In most cases, a blend of debt and equity from various lenders and financiers funds this type of transaction. As a member of the management team, you may need to pool resources with your colleagues to purchase all or a portion of the business you are currently managing. During the MBO process, it is vital to carry out a thorough valuation of the target company. This valuation should encompass a detailed financial analysis, accounting for any existing debt, as well as an assessment of the company's market position and future growth prospects. Finally, the acquisition process of a management buyout will involve negotiation, due diligence, and determining the final terms of the deal. It is vital to strike a balance between minimizing risk and optimizing the benefits for your management buyout team, as well as any lenders or financiers involved in the transaction. Throughout the entire process, it is essential to maintain a confident, knowledgeable, and clear communication style. By following the guidance in this section, your management buyout deal should be well structured and poised for success. The management buyout process. When you embark on the management buyout (MBO) journey, there are several steps to consider. Understanding the MBO process helps ensure that your team successfully acquires your target company through diligent planning and execution. First, you need to establish your MBO team, the management team that will be taking over ownership of the company. This group's individuals should possess complementary skills, strong dedication, and a clear shared vision of the company's future direction. After assembling your team, you will need to assess the company's value. This can be done by conducting due diligence, which involves thoroughly examining the company's financial statements, operations, and legal documents. Due diligence serves to identify any potential risks or liabilities during the MBO process. Based on this information, you can decide on the appropriate purchasing price. In the next step, you need to secure financing for the MBO. This typically involves obtaining support from banks, venture capital, or other lending streams. 1. It is vital to have a solid business plan that outlines the growth strategies, profitability projections, and refinancing options in your application to lenders. You should also discuss any existing debt and demonstrate the company's ability to service it. Once you have secured funding, it's time to negotiate the purchase terms with the target company's owner. You will likely need to agree on a purchase price, payment structure, and other conditions. This process is critical, as it solidifies the agreements to transfer the company into the management's ownership. Upon finalizing the purchase agreements, you may have to make regulatory filings or notifications in the event of management by INS. In such cases, you would be acquiring a company without previous operational experience within it. Follow the necessary procedures, and consult legal experts to ensure compliance with regulations. Throughout this process, communication is crucial. Make sure to keep involved parties informed of all developments. Clear channels of communication can help to alleviate any concerns and maintain a positive working environment during the transition. Remember, navigating the MBO process can be challenging, but with proper planning, diligent execution, and a strong team, you can successfully complete the management buyout and begin your new venture as a business owner. Assessing feasibility of buyout. Before embarking on a management buyout, it's crucial to determine the feasibility of the buyout. Start by conducting a thorough evaluation of your company's current financial position. Analyze the company's historical financial performance, including sales, profits, and cash flow. This will provide you with a robust base to assess your company's future potential. Consider the following factors as part of your feasibility assessment. Cash flow. A successful buyout requires a company with strong and stable cash flow. Assess your company's cash flow projections and ensure that they can sustain the ongoing operations, debt repayments, and potential growth plans. Financial information. Gather comprehensive financial information, including balance sheets, income statements, and cash flow statements. Investigate the company's assets and liabilities to gauge its financial health. Transparent and accurate financial information is imperative for making informed decisions. Growth potential. Analyze your company's past performance and market position to gain insight into its growth potential. You need to be confident that the company will continue to grow and generate profits post-buyout. Management capacity. Assess the abilities and strengths of your management team. A strong management team is essential to ensure the company's ongoing success after the buyout. Take your time to carefully consider all aspects of the proposed management buyout. Weigh the benefits against any risks, and analyze the most critical success factors. Remember, embarking on a management buyout is a significant decision that will impact the future of the company and your professional life. Thoroughly examining the feasibility will allow you to make a well-informed decision based on facts and figures, while adopting a confident, knowledgeable, and clear approach. Legal aspects and regulations. When undertaking a management buyout, MBO, it is essential to be aware of the legal aspects and regulations governing the process. This involves understanding your responsibilities, abiding by the guidelines set by the Financial Conduct Authority, FCA, and working with experienced legal counsel to ensure compliance. Firstly, ensure that all agreements, contracts, and due diligence documentation are in place and accurate. Engaging a solicitor with expertise in MBOs, such as those from MLP Law, can provide valuable guidance throughout the transaction. Additionally, it is necessary to obtain independent legal advice to avoid conflicts of interest and protect all parties involved. Understanding and complying with tax regulations is also important. You may be required to pay stamp duty, land tax, VAT, or other taxes during the MBO process, so seeking advice from a tax professional is highly recommended. Additionally, be aware of any industry-specific regulations that may apply to your company and the MBO transaction. For instance, certain sectors may require regulatory approval or licensing from governing bodies. Thorough research and consultation with experts can ensure that you are aware of all necessary compliance. Finally, consider any employment law implications that may arise throughout the MBO process. Protecting employees' rights and addressing any changes to their contracts or working conditions is crucial, as failure to do so could lead to legal disputes. In conclusion, navigating the legal aspects and regulations surrounding a management buyout can be complex, but with the right advice and support, you can ensure a compliant and successful transaction. Risk factors. During a management buyout, MBO, there are a few significant risk factors you need to take into account. These risks can impact the success of the transaction and the future performance of the company. One of the main risks is the debt burden associated with MBO loans. Typically, an MBO involves borrowing a significant amount of money to finance the buyout. This debt financing can put pressure on your cash flow and limit your ability to invest in growth opportunities. It is crucial to have a solid financial plan in place to ensure your company can meet these obligations. Another risk to consider is the leverage buyout (LBO) process. This type of buyout involves using borrowed funds to acquire a controlling stake in a company, with the acquired company's assets used as collateral for the loan. While LBOs can potentially offer an attractive return on investment, they also carry inherent risks. If the acquired company underperforms or fails to generate sufficient cash flow, you may struggle to repay the loan, putting your business at risk. Be cautious and carefully assess the target company's prospects before proceeding with an LBO. Additionally, the management team involved in the buyout plays a crucial role in its success. A weak or inexperienced team can hinder the company's performance, limiting its ability to generate the necessary cash flow to service the debt. It's important to ensure the management team possesses the right skills, experience, and commitment to drive the company forward post-buyout. Lastly, it's essential to be aware of the external market factors that could impact your business. Changes in regulation, market conditions, or competitive landscapes can significantly influence your company's performance. Stay informed of these changes and develop contingency plans to adapt to the evolving business environment. By understanding and addressing these risk factors, you can help ensure the success of your management buyout loan and set your company on a path toward stable growth. Success stories and case studies. Management buyout (MBO) loans have helped a number of businesses maintain continuity and grow. These case studies demonstrate how different companies have benefited from MBO financing as a succession route. Our successful management buyout case study. The law firms, which uses a holistic approach to navigate complex challenges, working closely with the seller's solicitors to ensure a collaborative transaction can secure the best outcome for the future of your business. Some banks feature several cases in which MBO funding has facilitated positive results for businesses. Through various financing schemes, the bank has supported a wide range of companies, enabling them to flourish and continue operations. In the care home industry, we assisted in securing finance to build a new care home from the ground up. The funding enabled the transformation and refinancing of underperforming care homes, as well as helping care home managers acquire ownership of the facilities. Buyout loans have enabled businesses across various sectors to achieve their goals, maintain continuity, and ensure a smooth transition. By choosing the right investor and having a strong management team in place, your company can also consider MBO financing as a viable succession route. What are the funding options for a management buyout? There are several funding options available for a management buyout. Some common sources include bank loans, private equity, and mezzanine finance. Additionally, seller financing and the use of existing cash reserves may also be considered. It is essential for you to evaluate all potential funding sources based on your specific circumstances and financial needs. Learn more about funding options for management buyouts here. How does a leveraged management buyout work? In a leveraged management buyout, LMBO, the management team acquires a company using a mix of equity and borrowed funds, with a majority of the transaction amount being funded through debt. The acquired company's assets are used as collateral for the borrowed funds. The key characteristic of an LMBO is the high level of leverage, which can enhance potential returns but also increase risks. What are the potential advantages and disadvantages of a management buyout? Advantages of a management buyout include the familiarity of the management team with the business, the potential to pursue new strategies, and the possibility of increased rewards for the team through owning shares in the company. However, the process can be time-consuming and complex, with significant risks, especially if the management team lacks experience in executing buyouts. Additionally, the high level of leverage may lead to increased financial pressure during tough times. What are the key steps in the management buyout process? The management buyout process typically involves assembling your management team, assessing the business's potential, and determining the valuation. You will also need to secure financing, negotiate the purchase terms, perform due diligence, and complete legal documentation. It is critical to follow a structured approach and seek professional advice at each stage to ensure a successful outcome. How can the valuation of a business impact the buyout? The valuation of a business plays a crucial role in deciding the purchase price in a management buyout. A higher valuation can result in a higher purchase price, which may make financing the transaction more challenging. Conversely, a lower valuation could make the transaction more attractive to potential financiers. The valuation needs to be accurate and based on sound assumptions to reflect the true potential of the company. Are there any tax considerations to be aware of during a management buyout? Tax considerations can have a significant impact on the structure of a management buyout. Different tax treatments apply to various elements of the transaction, including the financing structure, the sale of assets, and the treatment of share ownership. It is essential to plan for these considerations with the help of tax and legal experts to ensure that the transaction is structured optimally and compliant with tax regulations. For more information, you can contact us by clicking the link in the description of this video. Thank you for listening to our podcast. We look forward to coming together again in the next episode to share more information and experience with you. For now, goodbye.